Hello friends, welcome to Hamsa Accounting. Continuing with getting familiar with the basic accounting terms. In this video, we will explore the term capital. For a detailed introduction on assets and types of assets, please go through the video on basic accounting terms part 1. Business needs money. So this is the most basic thing which is needed by a business. This money can be either be funded by the owner or this money can be obtained from someone else who is outside the business as a loan. So these are the two main sources of obtaining money by a business. Money provided by the business by the person starting that business is called capital. So it is the owner's contribution in the business. Money obtained by way of loans or borrowings is termed as liability for the business. So liability is the obligation or debts payable by an enterprise in future. Let's learn the classification of capital. So capital can be represented by three types. These are contributed capital, capital reserves and revenue reserves. Contributed capital. Amount contributed by the owner or owners is termed as contributed capital. Why I said about owners? Because sometimes a business may have a few joint owners, as in partnership business. Other businesses like companies may have thousands of owners, also called as shareholders. Hence, small amount of money contributed by hundreds and thousands of shareholders is also capital for the business. So that's what about contributed capital. The second point is about capital reserves. People desiring to buy shares of valuable company are required to pay a premium over and above the base value or par value of shares. Right. So what we are trying to understand is the term capital reserve with the help of an example. Now suppose a life insurance company of India launches its shares in the market. If the par value or the base value of one share is rupees 10 and the company issues premium of rupees 900, then a buyer would pay 890 rupees more, that is 900 rupees minus 10, which was the base value. A buyer is paying 890 rupees more, which is termed as share premium. Now this money, this share premium, is also a part of the capital of the company, but there is a catch that this amount of money cannot be used for normal operations of the business. It can be used for financing long-term assets, for purchasing long-term assets. Therefore, under capital reserves, this can be represented by surplus from shareholders, which is called as share premium, or unearned surplus arising from transactions involving non-current assets or fixed assets. Let us understand this part also, the second part, transactions involving non-current assets or fixed assets. Suppose a business which is engaged in selling washing machines had bought a car to be used for office purpose at rupees 10 lakh 2 years ago. Alright, a company which is involved in selling washing machine has bought a car 2 years ago and it paid rupees 10 lakhs. After wear and tear of 2 years, this used car will be valued at less than 10 lakh obviously. So let us say the present value of the car after 2 years is rupees 7 lakh. That means the fair value is rupees 7 lakh. In the market it will fetch 7 lakh if you want to sell it. Suppose the company has managed to sell this car today, that is after 2 years of its purchase, at rupees 8 lakh. So the fair value was 7 lakh. Now the company has managed to sell it at rupees 8 lakh. In this case, the company has made a profit of rupees 1 lakh. Alright, so this profit of rupees 1 lakh has not been earned by the company from its normal business activities. Normal business activities as in its main business was to sell washing machines and not to buy and sell cars. So therefore, this profit is not been obtained from normal activities of the business, and therefore it is also a part of capital reserve of the company. And this amount of money also can be used to purchase long-term assets for the company. It cannot be used just to distribute it away to the shareholders. Now let us go to the third one, which is revenue reserves. So as it can be seen, profit retained or reinvested by the business entity. It is also termed as revenue. It is also termed as reserves and surplus or retained earnings. All of these three terms mean the same thing. So let us understand this also with the help of an example. Suppose an enterprise made a profit of rupees 5,70,000 in a year. A company or whatever, a small business has made a profit of rupees 5,70,000 rupees in a year. The owner may or may not take out the entire profit, right? It's up to the owner to whether it wants to take out the entire 5,70,000 profit or to take a part out of it. Now if the owner decides to take only 5 lakh rupees and keep the remaining 70,000 rupees within the business, that is also possible. So if the owner has decided to take out 5 lakh rupees out of the total 5,70,000 and keep the remaining 70,000 rupees, then this 70,000 rupees is regarded as revenue reserves or simply reserves and surplus. So what the owner has done, it has not taken out the entire amount of profit out of the business. Some amount of profit has been kept in the business to be reinvested in future. In future, the next year the profit may not be enough. Past year's profit may come handy to rescue the business to do its normal activities. So this was about capital.